Hi traders! Today, I brought to you guys a new concept of trading called liquidity. Traders, it is important for you guys to understand this concept on chart, how market forms areas of liquidity on charts to execute their large orders. These area of liquidity have huge amount of orders reside above or below them. Most of these orders are of retail traders. As retail traders, we don't have much room for our stop loss, and our take profit is most times double of our risk or stop loss. Our stops are always a liquidity for big institutions. For traders, stop loss act as weapon to protect our losses, and at the same time acts as liquidity for the market. Traders, most of you guys have observed this fact that your stops are taken out by the market before giving a large move, even if your direction is correct. So many times market first takes out your stop and then moves in your direction. One of the reasons is that institutions always need large buy orders to fulfill their sell orders and large sell orders to fulfill their buy orders. Traders, we all use charts for our analysis to execute our trades, and these charts are used by institutions to manipulate retail traders and urge them to place orders by forming areas on charts and candlestick patterns which looks high conviction trades. Traders, technical analysis or price action is a tool by which we analyze the market, and at the same time this tool is used against us to manipulate us. That's why traders trading is a profession of patience, and the people who don't have patience are most likely to be victim of this market. Traders, one must understand these areas of liquidity before executing the trades. These area of liquidity are places where traders are most likely to take trades, like our support and resistance levels, trend lines, swing high and lows, areas of demand and supply, double top or bottom, triple top or bottom, previous day high and low, forex sessions high and low, weekly high and low, etc. Traders, most of my strategies are based on concept of liquidity. Sorry to call out these strategies as mine because they are based on SMC and ICT concepts. However, these concepts has given us edge, which can certainly help us not to become prey of market movements. Traders, in smart money concept, there is concept of inducement. Inducement is a place early buyers and sellers are induced to take trades. Most of our SMC entry models are based on inducement. Large amount of stop-loss orders are placed above or below it, which is liquidity for the market, and most likely to be taken out. Traders, let's understand this concept by the help of an example. Traders, upon closely examining the charts, you will observe that every swing and high was taken out by the prices sooner or later. Prices fell quickly, forming two bullish candles with large displacement moves. Traders, two opposite bullish candles are our order flow. This is the area from where market moved in its direction after giving a opposite move. These two opposite candles have huge significance for us, since large amount of sell orders has driven the market in sell direction. Traders, it is important to understand that last two bullish opposite candles are our order flow, and last candle before selling is our order block. Both of them are still unmitigated. It means that zone may have still some pending orders which market could come to execute. Due to the rapid fall in prices, almost immediately, prices left behind huge amount of inefficiency or orders which are still needed to be executed. Traders, as you can see, that after falling from that level, prices formed two pullbacks, inducement 1 and inducement 2. These inducement areas are created for retail traders to execute trades on pullbacks with their stop loss above pullbacks. Traders, you guys should understand that if traders were induced to take sell order buy stops were resting above these inducements, where market fulfill their sell orders. Traders, if you will look closely, prices had returned to the order flow or area of supply 4 times, again and again, inducing traders to execute sell orders, which was building liquidity above equal highs in form of buy stop orders. Traders, you must observe that before giving a large move, market took all liquidity above these equal highs and then moved to its final direction. Traders, this is very important concept to understand that prices first builds up areas of liquidity around the places of demand and supply zones, and then after, taking the liquidity from these areas and executing their remaining orders from demand and supply zone move to its final direction. As you can see in the chart, that prices first build area of liquidity in form of equal highs just below our unmitigated order block, and after taking all liquidity from equal highs and its pending order from order block, market moved to its final direction. So traders, I hope this video has given you guys a different perspective of how to look at the charts, how area A of liquidity are important for us, and how we can use them to our advantage, and how market manipulates retailers to take positions to fulfill their large buy and sell orders. Next time, I will bring a new example